Just weeks ago, Future Economics reported that the U.S. debt-to-GDP ratio stood at approximately 121.5%. As of March 1, 2026, that number now reads 124.2%. That is a 2.7 percentage point increase in a short window. The level matters, but the slope matters more. On February 18th, total federal debt stood at $38.603 trillion. 11 days later, it stood at $38.746 trillion. That is an increase of $143 billion in just 11 days. At that observed pace, the United States is adding approximately $130 billion to its debt every 10 days. $130 billion every 10 days. That equates to roughly $13 billion per day. If sustained, that implies a double-digit annualized growth rate in total federal debt. Future economics does not dramatize numbers, but sustained velocity at this scale compounds rapidly. This is not an abstract statistic. It is the construction of a financial mountain, layer by layer, as the days go by. Debt accumulation at this pace steadily pushes the system toward new nominal records. The debt is on an incline, and if this trajectory continues, it will once again set higher debt level records. There is another structural change worth noting. The Doge clock previously displayed two fields labeled expected savings and actual savings. Those fields have now been removed. They have been replaced with tariff revenue and revenue per taxpayer. That is a shift from projected reductions to recorded inflows. Regardless of presentation changes, the underlying debt numerator continues to rise. Future economics evaluates acceleration, not just totals. When debt grows faster than GDP, the ratio rises. When that growth rate itself accelerates, stabilization becomes progressively more difficult. The concern is not a single data point. The concern is sustained trajectory, from 121.5% to 124.2%. Approximately $130 billion every 10 days and growing. The headline is not fear. The headline is simple mathematics. Future economics will continue to monitor the slope. The slope needs to decrease because slope determines outcome.